Good morning, everyone, and thank you for joining us. My name's Michelle Waitley, and I'm the Executive for Commercial Real Estate at NAB. As we begin today, I'd like to acknowledge the traditional owners of the lands on which we meet. I'd like to acknowledge the Wurundjeri people of the Kulin Nation as the traditional custodians of the land on which I'm joining you from in Melbourne, and I'd like to pay my respects to all elders past, present, and emerging. So welcome to our last quarterly property webinar for 2025. We started the year with an economic review and outlook from Taylor Nugent, our NAB economist, and Ben Martin Henry from MSCI. In May, we were joined by James Stewart, formerly at KPMG, and Stephen Andrew from JLL, discussing the retail sector. And in August, Mike Zorbas, Chief Executive of Property Council of Australia, and Natalie Field from Informed Decisions provided their insights on the residential development market. Today, we're joined by CBRE to close the year talking about the office sector. This remains a common topic of conversation with our property customers as hybrid working continues to evolve, valuations have largely stabilised, foreign capital has returned to Australia, and the focus on ESG increases for commercial office real estate. Today, we will provide a national overview of the office market, the outlook on yield compression, rent expectations, incentives and supply, and what to watch for in 2026. As well as a market update, we also wanted to provide a tenant perspective. So we'll discuss occupier preferences and demand, themes in space and design of office fit out, strategies to secure tenants, and the impact of neighbours ratings. I'm joined today by guest speakers Tom Broderick and Diarmaid Killeen. Tom is the Head of Office and Capital Markets Research for CBRE in Australia. Tom works with a range of major CBRE clients to deliver regular market updates and thought leadership pieces on topics related to the economic landscape and commercial property trends. Tom has worked in a number of commercial property research roles within Australia and Hong Kong, and his qualifications include a bachelor's degree in urban and regional planning and a master's of economics. Diarmaid is Head of Occupier Leasing for CBRE based in Melbourne. He previously worked for GPT and now acts on behalf of occupiers across Australia. His clients range from major banks to legal, tech, and consultancy. CBRE is the largest tenant advisory team in Australia, and Diarmaid will take us through their recent occupier survey results and insights. Thank you to Tom and Diarmaid for joining us. The property sector remains critically important to the growth of the Australian economy. And as Australia's largest business bank, we are very active in funding all property asset classes across both development and investment. And we remain committed to supporting our customers in the office market. We have a very experienced property finance team who have a deep understanding of the property market. And NAB also offers green lending options, which can be used for office, development, and retrofit funding. So please speak to your banker if you'd like to explore the criteria for green loans. We will have time for questions after the formal presentations. Please use the Q&A function at the bottom of the screen and we'll get to as many as possible. And we're recording this session to share with you afterwards. On that note, I'm going to hand over to Tom and Diarmaid.
Thank you, Michelle, and hi, everyone. Let me just get my slides up. Okay, so the Australian office market. It's obviously been a very interesting couple of years for our sector with a range of kind of different topics to cover, which I'll cover today. I guess to start with the return to office, I have to talk about each and every day, and I have for the last 5 years or 6 years. So I feel a little bit like the lady from the Titanic talking about this topic. But it is still important, both for the occupier side and also investor side. Certainly, offshore investors are still interested in how markets in Australia are performing, particularly against the US. So this is the indicator that we've created, and we've used this for the past 4 or 5 years. Basically, 100% is not 100% of people in the office. It's 100% of the way back to 2019 levels. So I think what we've found is that the smaller markets have largely stabilised and are probably close to a steady state. So Brisbane, Perth, Adelaide sitting at kind of an average of 80 to 90% during the week, and on peak days, up near that 90% range. Sydney's improved quite significantly in the past 3 years, averaging 75% and peak in the early 80s. Certainly, things like the new metro have helped in attendance for the Sydney CBD. I guess where the conversation continues is Melbourne, particularly with kind of government announcements recently looking to legislate work from home. It's been lagging. It is still improving, but kind of at a slower pace. And I think these numbers are kind of important when you look at the occupier side. What I would say is the smaller markets, we're not seeing a lot of kind of contraction related to hybrid working anymore. Sydney, I think we're almost at the tipping point where we're not seeing it as much either. And I think Melbourne, we've still seen some contraction, although we are starting to see some organic expansion of that tenant base as well. So, in terms of how we're performing against the US, basically we've got 4 cities outperforming all US markets. There hasn't been a lot of improvement over the last 3 years in US markets, whereas as I mentioned, there is still some gradual improvement from a return to office perspective in Sydney and Melbourne over the last 12 months, albeit the improvement is slowing. So we're getting to that steady state from a return to office perspective. This chart's
Tom,
kind of
just to jump in on that last slide, from our perspective, when we have decision makers that need to approve deals, particularly in the US, we see that sentiment over there is a lot less than local businesses. So in terms of probability of a deal going through, it diminishes as it requires US approval.
So I think this chart we've spoken to a lot of clients about. It's quite interesting, but basically it shows the disconnect between white collar employment in Australia and occupied stock, so tenant footprint. Basically, the disconnect started in 2014. That was when kind of hot desking, activity-based working was really embraced, particularly by larger corporates. So they could use space more efficiently. Their headcount was growing, but they weren't growing footprint at the same rate. And then that's kind of accelerated that gap since COVID hit with hybrid working. Basically, national footprint hasn't changed since 2020, while white collar employment has grown by 15% in Australia. I think the takeaway here is that this isn't sustainable. Tenants can't continue to kind of densify their footprint and fit more and more people into the same footprint for the long term. We think we're getting close to that tipping point. And the reason we feel that is, as I've mentioned, the smaller markets, we're actually seeing the more normalized kind of headcount growth translating into footprint growth. And I think that's coming for the larger markets of Sydney and Melbourne as well over the next 3 years. And so at some point, we're going to see our net absorption levels start to return to more normalized levels as a result of headcount growth in the Australian economy.
I think on the ground as well, Tom, in respect to that slide, we've seen quite a lot of the larger occupiers right size over the last 3 to 4 years. And in some cases, they've overshot that, and in many cases now require the floor that they handed back again. So we're seeing that on the larger tenant side.
Yep. And I think, Diarmaid, that's a good segue into this chart, which is national sublease across the country, which is really normalised in the last kind of 18 months. We obviously saw a big increase in sublease availability coming out of COVID when those tenants were right-sizing. But now we're sitting at more normalised levels. And when you see the new sublease activity coming to the market, it seems to be less related to hybrid working and more related to change in business, etc. So that that has definitely normalized, and how it's translating into things like rental growth is when you've got elevated rental growth, when you've got elevated sublease, it's a real handbrake on rental growth, and we've certainly seen that in parts of Sydney and particularly Melbourne over the last few years. But given it's normalized in those markets, we think rental growth will start to improve, which we're seeing in our numbers.
I think off that one, Tom, the interesting thing will be where some tenants took the advantageous sublease conditions and have relocated into the CBD from fringe or suburban locations. Their rental reversion when they come off those sublease deals and what those tenants do will be interesting, whether they stay in the city where rents are forecasted to be even higher, or if they relocate back out to fringe and suburban locations.
Yeah, it's a good point. I guess the next topic, which is really important for the office market, is the supply situation. So I think what we've seen since COVID, 2020, we had a huge year for supply across the country, really at the wrong time when tenants weren't making decisions, and that's caused vacancy to rise. And we've seen some elevated years since then. The outlook is looking more promising from a landlord's perspective, not so much for an occupier's perspective. Our forecast for Australian CBD growth in stock is about 0.5% growth in stock per year through to 2030. That'll be the lowest kind of period of supply since the late 1990s. And really, it's kind of ended to 26 and 27. There's going to be a bit of a supply gap in 28 and 29. And I think the reason for that, there's a few factors. High construction costs have really had an impact across all sectors in commercial property construction, but also large institutional investors are kind of reweighting their portfolios. And so traditionally, the super funds would be putting money into these office projects. They're kind of less willing to do that at the moment. And so that's just leading to a lower kind of supply pipeline. And on top of the construction costs, that leads to higher economic rents, which I've got a slide in a second about. But basically, tenants have to pay significantly higher rents to commit to these new projects, and not every tenant is willing to. Some tenants certainly are to be in the best of the best stock, but not every tenant is willing to do that.
I think the interesting thing here, Tom, was that the last time we were in a position like this was that kind of 2017 to 2019 period. But we knew there was a big supply hit coming through in 2020. Obviously, we didn't know about COVID. Whereas now we don't know when that supply is coming from an occupier point of view. So it'll be interesting to see how the occupiers react to that. Will that lead to more renewals? We're starting to see a little bit of that.
Yep. And I think, I mean, just to point to that 2030 figure, that's really just an assumption we're making. Like there's not actually a project in our pipeline under construction due for 2030 right now. So we're just making an assumption that something does start construction in the next 12 to 18 months across Australia. As I mentioned, vacancy has increased across most markets. Brisbane's probably been the outperformer. It's one of the few markets globally where vacancy is lower now than it was in 2020. But basically, national CBD markets are outperforming non-CBD markets. Typically, what we've seen, particularly in the larger markets of Sydney and Melbourne, is tenants upgrading both in terms of grade but also in location. So we've seen certainly a level of centralisation because there's pretty good deals on offer in CBDs, and that's why those CBD markets have held up better, and that's why prime markets have held up better than secondary markets. From a rental growth perspective, Brisbane's been leading the pack for 3 years now. Effective rents in the Brisbane CBD have grown by about 30% over the last 3 years, albeit coming off a relatively low base. Sydney's been relatively strong for the past couple of years. It's largely been led by the Sydney core precinct. But what we are seeing in Sydney is that there's better rental growth in the past few quarters in Midtown, Western Corridor, etc. So that is an indication that those markets are starting to improve, and tenants are kind of considering those markets again because they're looking relatively affordable to the core precinct. Melbourne is the one that's kind of lagging. I think the important point to point out for Melbourne is there's a huge discrepancy in precinct in Melbourne. Eastern Core sitting at 8% effective rental growth over the last 12 months, Docklands negative 18%. So there's been a huge discrepancy. And Dim, this is your home market. So
Yeah, I think
what are you seeing on the ground?
Tom, even within precincts, even Eastern Core, it's building to building specific. A lot of vacancy in the low rise of that end of town, whereas high rise, very little vacancy and rents are climbing even faster. I think the flow-on effect is that Eastern Core is such a small office market that it has to flow down to the Western Core, which is on the far right hand side of that graph. And it's probably the biggest office inventory. At the moment, it's on the far right. We probably see that moving along to the left over the next kind of 24 months.
Yep. And I think just the last one on rents, I mentioned economic rents, but basically what's happened is high construction costs, along with cap rate softening, has pushed economic rents significantly high across the board. And landlords are responding to this. They know that their existing assets look relatively cheap on a rental perspective compared to new development at the moment. So this is an example in Brisbane where you would argue that construction costs have probably increased the most in Brisbane over the last kind of 3 years. So basically on our numbers, economic rent is sitting at about 30% premium to existing buildings on a gross face basis. The long-term average is about a 19% discrepancy. So if you were to assume that existing buildings have to catch up to economic rent over the next 5 years, then basically rents have to grow at 4.6% per annum to close that gap. So that's pretty solid rental growth. Brisbane's been achieving that for the past couple of years on a gross face basis. But you could say that this is really a trend across basically every market in the country at the moment. And when you look at fringe markets, the gap is probably even bigger at the moment. So it's really hard to get kind of fringe development out of the ground because the economic rents are significantly higher than the existing market. And that's why we've seen supply drop in those markets as well, is that it's much cheaper for tenants to renew in existing buildings rather than consider new developments. And typically in fringe markets, the tenants are much more cost conscious than CBD markets, so maybe less willing to kind of commit to new developments. And so this is our national rental growth across face, effective, and incentives. So effective rents on a national basis have returned to pre-COVID levels just in the past quarter. And obviously there's big discrepancies between markets from that perspective. But I think the call out that I'd like to make here is that incentives have been kind of stubbornly high for the last 3 years, averaging about 40% in CBD markets in Australia. And so I think the main point I would make around that is that tenants typically expect for their fit out to be paid for these days, particularly large corporate tenants. And so it's hard for landlords to wind down those incentives when fit out costs have increased significantly. Really, the only market where we're seeing genuinely tighter incentives is in the Sydney CBD. And the reason for that is that because of the higher face rents, basically there's leftover abatement in new deals. And so landlords can eat into those incentive levels and kind of eat into the abatement. Whereas if you look at market like Melbourne and Brisbane's the same, almost all of the kind of incentive is getting eaten up by fit out cost. And so it's hard to kind of wind those incentives down. I don't know if that's what you're seeing in the market, Diarmaid.
Yeah, I think the cost of capital for landlords as well has been difficult for them, and we're seeing a lot of landlords now limiting the the form of the incentive and trying to blend a portion of that as rental abatement instead of 100% capital upfront. That is quite detrimental to a tenant trying to relocate to a new building. They, as you said at the start, really need that incentive to help pay for the fit out and justify paying the face rent over doing a renewal deal. And so we're seeing some cases where tenants are saying, okay, well, we've got an existing fit out, might be a bit too big, but we're better off staying where we are and taking the incentive as an abatement on the renewal and kicking the can down the road. But given where the market is heading and lack of supply, that's also a difficult position for a tenant in 3 to 4 years' time as well. So I think where the tenant can get the incentive to pay for the fit out, they're more likely to move.
Yep. And just quickly on non-CBD markets, again, Brisbane near city kind of outperforming largely in line with where the Brisbane CBD sits. We have seen an improvement in rental growth in some fringe markets. So I think the call out would be Parramatta and St Kilda Road, which have seen quite significant increases in vacancy over the last 5 years. So kind of quoting 4 to 6% effective rental growth, people kind of question. But I think what I would point out is St Kilda Road effective rents are sitting 30% below peak levels. So they're coming off an extremely low base and they're starting to pare back those losses. But again, tenants start to see that there's pretty significant discounts in some of those precincts, and so they start to return and activity starts to improve in those markets. On the capital markets front, this is transaction volumes up to Q3, and basically we're sitting 20% below last year from an office perspective. The main reason for that is there's been a slowdown in activity in Sydney. Sydney saw some major transactions in 2024 and hasn't seen the same level of transactions in 2025. Brisbane and Melbourne have slightly improved from last year. And then the smaller markets, particularly kind of Adelaide and Perth, there's been relatively few transactions of office assets in those markets. So, yeah, I think we were kind of expecting improvement from last year, and that hasn't really eventuated. But we are starting to see some opportunistic capital come back into the office market. And this is kind of the main thesis behind investing in office markets at the moment, is this discount to replacement costs, which you could argue is across sectors. You could make the argument for an industrial and retail at the moment, but I would say that the gap between existing assets and replacement is the largest in office at the moment. And really, existing buildings are selling at 40 to 50% discount to replacement. This, again, feeds into that lack of supply story, because it's really hard to kind of convince capital to invest in a new project when they look at all the sale evidence and assets are selling at this 40 to 50% discount. And investors are wondering, well, why would I buy into a new project at full price when I could get a significantly discounted existing asset? So we expect, I mean, this gap has to close over the medium term for supply to kind of make sense again. And we are starting to see capital value appreciation, particularly in the stronger markets of Sydney and Brisbane. And that is leading to some level of cap rate tightening. So that's That's all I've got from my perspective. I'll hand over to Diarmuid to talk through the occupier survey.
Thanks, Tom. Yeah, so we undertook a occupier survey in Asia and Australia. We extrapolated the Australian survey results, which was the highest number that we've ever had. So it gave us a real good data set for what we're going to take you through, which is really focused on return to office, office usage, and deal preferences. So the first slide there is on office attendance. When we surveyed the clients, the strong preference was around that 3 days a week expectation versus attendance. So we're seeing that attendance is slightly behind expectation at the moment. But on the next slide, you can see that the smaller companies are really outperforming the larger companies. So employee expectation is 3 days a week overall, but the larger companies are coming in at about 2.9, whereas the smaller companies are coming in at 3.1. The companies do expect improvements in attendance from here. So looking at increasing office attendance by 58% on the smaller companies, and larger companies are kind of at a steady state. I think anecdotally, when we talk to leaders within our clients, such as CFOs and CEOs, the expectation is that more people come back to the office next year. And I think, yeah, next slide will cover off on some of that as well. So headquarters are typically outperforming over other office types. So not surprising where, the leadership is based, there's a higher level of attendance. And we see some of those back of house offices, such as those in maybe the Docklands in Melbourne, where office attendance is a lot less because it's more back of house functions. In terms of mandating, predominantly most organizations aren't mandating, and if they are, they're maybe not enforcing it very well. And when we do talk to the leaders, they really want to flip this, but they're waiting for the right time. So there has been some organizations that have led the way in that regard, and others are sitting on the fence. I think you'll see the ones that led the way kind of enforcing it a bit heavier and strictly, and then the rest will follow suit with expectations. In terms of challenges and what our clients are facing with respect to office attendance, it's overwhelming that the amount of people that complain that there isn't enough small rooms on peak days. So an example of me right now, I'm in a small room, but it's probably for 6 people and could be just for one person. So we see that across the board. I think what that will mean going forward is that as occupiers accommodate that within their fit out, they'll probably need to take some extra space as a need for that compartmentalization of the fit out. And also then a lack of vibrancy on the lower attendance days. Mondays and Fridays are the worst performing days. Mondays are getting better, but Fridays are really bad. And leaders want to try and get people back when they're trying to understand how they can flatten the curve over the week. Because there's a lot of peak between Tuesday, Wednesday, and Thursday. And when they're trying to set their target growth aspirations, they know they've got capacities on Mondays and Fridays, but they have to accommodate for the peak days being midweek. Tenants are returning to more of a steady state over the next coming 3 years. I think the last 3 years has really been focused on contraction and right sizing, handing back space. But as I mentioned earlier, in some cases that's gone a bit too far, and the tenants are now coming back and taking back floors that they previously handed back. And so we're seeing a lot more focus on expansion than contraction in this period. In terms of decision making and what drives a tenant, both in a renewal scenario and a relocation, it was interesting the responses that we got. I think the first one there, asset preferred location, really sits across both. Most tenants want to be in the prime location. we've seen a huge amount of tenants vacate from secondary locations into the prime locations and then into prime buildings and then into the prime floors within the buildings. That's why we've got quite a lot of vacancies in the low rise in east of Melbourne, for instance. The other things that they're looking for is obviously the deal metrics, as I mentioned earlier, around a renewal versus a relocation and abatement versus capex of a new fit out. And then around the relocation, it's about the amenities and services that suit the employee's experience. We see a lot of decision making around, okay, let's relocate, let's get a little bit smaller, move to a better location, a better building, maybe a higher floor, and that will allow us to right size and then drive attendance into the office, which a lot of tenants have taken advantage of. And then obviously lease flexibility, that is important to tenants as they right size. They do want to have that bit of flexibility as well, whether it's a break right or a growth right within the lease. One of the major drivers for tenants is getting people back into the office is obviously public transport and car parking. So we've seen quite a lot of suburban and metro tenants coming to centralise and take advantage of new train lines in Sydney and Melbourne, which is about to open as well. So that is a major driver for decision making. In terms of sustainability, because I know it's an important aspect, I do think that the landlords are well ahead of the tenants in terms of their understanding of sustainability and what they need to do to entice tenants to their buildings from a sustainability perspective. The tenants are saying that they're on track to achieve their goals. There's going to be more and more scrutiny on occupiers in terms of sustainability, whereas I think previously it's been mainly on the landlords. And a lot of the tenants will piggyback off what a landlord has done from a sustainability initiatives perspective. And it's not just neighbours or net zero. It's everything from, where is the power coming from? Is it green? Is there solar? And the recent development in Melbourne from Cbus, which has a solar skin facade, just adds to that kind of appeal for tenants. But yeah, that mainly covers off from an occupier's perspective in terms of what they are looking at in the Melbourne and national market. I'll pass back to Michelle now for any Q&A questions.
Thanks, guys. Just a reminder that there's a Q&A function at the bottom of the screen. So if you've got any questions, please pop them in there. But we might start with, there's obviously a lot of conversation around AI at the moment. So really a question for both of you. How do you think AI is impacting office demand in Australia? And what do you think, that's going to look like in the next 12 to 24 months?
Yeah, I think this is the hardest question to answer for a researcher in the office sector at the moment. We could have Sam Altman from OpenAI on this call, and he wouldn't be able to tell you the impact of white collar employment in 5 years' time. So it's pretty difficult to forecast. What I would say is that, there's a huge discrepancy in predictions. Some are saying that there'll be a net positive in white collar employment, particularly at the front end. But then there's others saying there'll be 20% loss in white collar employment over a 5-year period. And I think I find it hard to see that scenario playing out. Like let's take Australia, for example, if we lost 20% of white collar employees, our unemployment rate would rise to about 12%. That is the highest it's been on ABS records. No incumbent government is going to survive that level of job loss. So I think around the world, there's going to be a response from governments around this issue. I think what I am most concentrating on at the moment in terms of kind of tenant demand and white collar employment impacts is what's happening in the US. the only evidence I think I've seen in the US, there's obviously headlines around Amazon cutting staff related to AI, but what the media is not good at explaining is that some of these companies have hired significantly over the last 5 years. Like they've hired, let's say, an increase in 10 to 20% in headcount over that period. And so, yes, there are job losses, but I don't think it's quite as bad as the headlines suggest. The one thing I am keeping an eye on is that the unemployment rate of graduate level people in the US has slightly increased. And I think we all know that that is the kind of cohort that will be impacted by AI because AI is able to do the kind of repetitive kind of jobs that those graduate level people typically do at the start of their careers. And so that is a watch for me. It's only been a slight increase in the unemployment rate of that cohort, but that is something that I'm keeping an eye on. But from an Australian perspective, I can't kind of point to any occupier decision that is specifically related to AI at the moment.
Yeah, for us, it's not really coming up in conversations with leaders around decision making just yet. I think it's sitting in the background. Lease flexibility is important as a result of that, particularly at the back end of a lease. Um, it's interesting. We were talking to our colleagues in San Francisco, and they're so busy at the moment with clients needing extra space because of AI. So look, there might be a curve where it goes up and then it comes down again, but right now, places like San Francisco, there's massive demand.
Thank you. Diarmaid, while you've got the mic, what level of amenity are occupiers looking for? So cafes, end of trip, and how important is wellness in the wider offerings?
Yeah, it's the next frontier of tenant amenity, and we're seeing some really innovative offerings from landlords in the market. Um, Personally, I would say well above the expectation of an occupier or a tenant, and it probably goes to the fact of how competitive it is out there for landlords on vacancy, but also justifying maybe some of that rental growth. Um, we're seeing things like, particularly from, say, the co-workers, there's a development where a co-worker has gone in, taken some co-worker traditional floors. They've added a gym, they've added, baths and saunas and all of the kind of wellness that you would expect from a health club. And that building now is releasing up exponentially quicker than its competitors. Um, at the same time, it does also benefit the buildings nearby it because I had a tenant through it yesterday and they said, it's a good building, but I could be next door and then become a member and get all the benefits as well. So you probably need to be careful as to how you position those wellness offerings and maybe some priority within the buildings. But it's definitely top of mind. And I think when the leaders want their staff back in the office, it's those types of things that are going to get them in. I think in the trip is now an expectation, and if you hit a certain level, then it's a tick. If you didn't have one, I think it's a negative, but yeah, most people kind of expect it now.
Okay. And then in terms of floor plate design, how do you help tenants understand that office usage? You were talking before about, the small rooms, more small rooms, and then what that does to floor plate and space that's required. So how do you help your tenants work through that?
Yeah, well, we do have some in-house workplace advice that they can work through in terms of calculators and things like that. Um, a lot of it at the moment is anecdotal feedback from the tenant in terms of what they've got now and what their demand is. You kind of have to get to a very granular level
With
understanding what their business needs are. A lot of speculatively built fit outs at the moment delivered by landlords on, say, the sub 1,000 square meters. And the feedback we get on inspections every time is there just isn't enough of those smaller meeting rooms or Zoom rooms. And then as a result of that, they have to be added in adds extra cost, complicates the transaction. So I think for the sub 1,000 square meter tenants, if there's speculatively built fit outs, that really needs to be thought, or at least provisioned for. The over 1,000 square meter tenants are really going into that kind of deep design, deep analysis of their staff.
Great. Tom, just back to you. Talk to us about cap rates and what we're starting to see in the Australian market.
Yeah, I think we have a basket of buildings across the country that we talk to our valuers and capital markets brokers about cap rates every quarter. What I would say is that most markets we've seen a stabilisation of the last 12 months, and I think Sydney is probably the only market where there's been genuine evidence of maybe some tightening, but that's very precinct specific and sentiment driven, particularly in the core of Sydney. That is where kind of global investors want to be in the Australian office market at the moment. So there's a bit of competitive pressure there for campaigns that our agents are running. Other markets, I think we've seen this degree of stabilisation. I think Brisbane might be the next market where we actually see some tightening. But yeah, early stages of the tightening cycle, I think. Whereas like industrial, we've seen tightening kind of for the last 12 to 18 months, and some tightening in retail. So yeah, the office is kind of lagging those two sectors at the moment, but starting to see some competitive pressure.
Okay. And then just in terms of transactions this year, we've seen quite a bit of offshore capital come. What countries is that coming from, and what's their preference for the type of office that they're looking for?
Yeah, I think the two source markets most active, Japan has been kind of the last 3 years, but then US North American investors have also started to get more active. So I think, as I mentioned, those offshore investors want to get set in the best of the best stock. They see this current market as kind of the trough. And so it's kind of a once in a decade opportunity to get set in the Sydney CBD. And then I think what will happen is they'll start to look out. Typically what's happened through cycles is that they start to look at other markets, like Melbourne and Brisbane and Perth. So we probably haven't seen that, although there has been an offshore investor, PAG, who's bought 2 buildings in Melbourne, and recently a Singaporean investor bought an asset off GPT as well. So we are starting to see an improvement in markets outside of Sydney, but Sydney, I think, is still the number one kind of target market for offshore capital. Brisbane and Melbourne are probably a long way second at the moment.
Okay, thanks, Tom. What's CBRE's perspective about building costs? Do you think that they're going to stabilise or decline? Decline would be good.
Yeah. I mean, Mirvac came out a few weeks ago and said that they're seeing a big drop off in activity from next year in Melbourne, for instance. That's the first kind of major developer, I think, that's kind of said that. I think the challenge that we've got is we've kind of got elevated infrastructure investment across the board, across all states at the moment from a government perspective, and that's eating up a lot of labour. And I think the other challenge for commercial sectors is all governments, state and federal, are laser focused on the housing crisis at the moment. And so they need to get kind of development out of the ground and supply out of the ground, because it's pretty clear that we're not meeting our housing targets at the moment. And so I could see that being a challenge for our sector, that all the resources are getting diverted to kind of the living sector rather than commercial sectors. I could see a scenario where kind of building costs just stabilise for a couple of years and the existing market catches up. And that's that makes development stack up again in the office sector, for instance. But it's going to take a couple of years of rental growth and kind of capital value increases for that to actually kind of translate. So yeah, I still think that development in our sector, office sector, is going to be difficult for the next kind of 18 months until the kind of existing market catches up a bit.
Thank you. So next question is around flight to quality that we're seeing around the country, and what do you then see, B and C grade buildings happening with those?
I think there's always a flight to quality from the grade below. So B to A to premium. So we continuously see tenants moving up, and a tenant in the suburbs isn't going to move directly into the prime building. And so as those tenants are moving along, the next set of tenants are kind of coming in to take their place. I suppose the best example of that is probably being in the Docklands in Melbourne, where there is elevated vacancy there, and some of the big corporates like some of the banks have moved out of there or downsized and released space that wasn't available previously. And as a result of that, tenants have come from the suburbs and taken their space. I think those tenants are still expecting the amenities that I mentioned before, maybe not at the level of the wellness that I mentioned, but the end of trip, a good lobby cafe, business hubs and business meeting rooms and facilities is something that there's been a lot of investment by landlords on as well. And tenants are they're liking that, particularly the town halls, because the town hall does take up an awful lot of space within a fit out. And if you can shift that to a neutral space within the building and just pay for it on an as needs basis, it does make a lot of sense to those tenants.
Yeah, I think the only thing I'd add to that is like upgrading your space is really the easiest way to organically improve return to office. And that's, I think, why we've seen this trend for 5 years running, is that like companies have had mixed results from mandates, etc. Whereas if you kind of genuinely offer a really good kind of office space, then that does organically bring people back. It's still kind of the best solution, I think, for some business leaders.
Okay, and Diarmaid, you had a slide about vacancy in the secondary office for Parramatta and St Leonard's. With the level of vacancy in those, do you see those assets being repurposed, and what for?
I think in those secondary markets, it's probably very building by building specific. I think 3 or 4 years ago there was a lot of talk about repurposing office buildings. We haven't really seen that come to fruition as much as it was spooked at the time. Again, those costs are very expensive, and I think a lot of those buildings are kind of waiting for that trickle down effect from the prime buildings, and it'll eventually catch up. So trying to do a deal that kind of bridges you to that market, maybe it's short term, and it's a reduced financials than what you would like, probably still stacks better than doing a total asset conversion. But again, it's very subjective to the building and the qualities of the building.
We've seen a few examples around the country of conversion to student accommodation in the past few years. Again, like there is a lot of institutional capital for that, like conversion into living sector. So I think it definitely you can't do it for every building. That's the issue. But I could see it continuing to be a trend, particularly given kind of the housing crisis that we've got in this country.
All right. Well, we might leave it there. Thank you so much, Diarmuid and Tom, for sharing your time and your insights today. And thank you to our audience for dialing in. I hope you found today's webinar interesting. For our customers on the line, I would like to take this opportunity to thank you for your custom. We do really appreciate your business and the relationship we have with you. And NAB is committed to working with our customers to finding solutions together. So please speak to your banker about new opportunities and any needs that you may have. I just wanted to mention that given the current economic environment, there's been quite a lot of market volatility, which has created some really good hedging opportunities. And we do expect that data releases will continue to create opportunities in the coming months. So if you'd like to explore any interest rate strategies, please let us know so we can put you in touch with our market specialists. You will receive a survey as the webinar closes. We really do appreciate when you take the time to provide us with feedback and also any suggestions you may have for topics for our quarterly webinar series for 2026. So wishing you all the best for the end of the year and the festive season, and thank you and goodbye.